All right, Dr. Jack, let's get going. Recently you've been talking about three bubbles in the U.S. economy. Let's talk about those bubbles. What are they, and how dangerous is it?
Yeah, well, obviously, the bubble that everyone's aware of is what's going on in the stock market. If you look at the three major U.S. stock markets, the Dow, the Nasdaq, S&P 500, what you've got is prices going. The numbers here: 13%, 10%. 12% just in the first 9 months of this year, following about 25% last year, the 25, 30% and all these. So you got in the last 18 months or so, you got the stock markets in the US up like 40% in that shorter period. That's obviously a bubble. The question is what's driving it. We can talk about that in a minute. The other bubble is the crypto bubble, right? Bitcoin and others are up even more over the past 18 months and this year. And then, of course, in addition to that, you've got gold going through the roof, gold prices going through the roof. So you got a gold bubble going up just this year, 9 months of this year. It's gold prices are up 57%. So, and that's after 30% last year. So gold price is almost doubling. Now you got to understand all these bubbles are linked. They're not separately driven by different factors. They're all financial asset markets. And when you have certain conditions in the U.S. and global economy, investors start moving their money into these financial asset markets, not only because the big profits are there, but because it's kind of a safety zone. If you put your money in financial assets, you can get it out pretty quick. It's not like if you want to invest in a factory or in a big inventory data centers, so whatever, you can't get your money in out as quickly as you can. So it's kind of a safety thing, but it's also where the big profits are. And the nature of these financial asset markets is that it's driven by demand. Supply is not a much of a factor in this. You can create stocks and you can create cryptos. Well, cryptos they control the supply, but all these assets are demand driven, and if you have increased demand in these asset markets, the price goes up of gold, of cryptos, of stocks, right? And it sucks in even more demand because you got speculators trying to make paper super profits from demand. So demand feeds demand, and it goes up and up. But what this also does is it sucks money capital out of the real economy, and you start having less relative investment in the real economy here. And that's been going on in general in the 21st century, but now it's kind of accelerating. But if you look at what's behind this, okay, so let's say what's behind the stock market. It's mostly artificial intelligence. You have 7 or 10 big AI companies, Meta and Google and Microsoft and so forth, and they're investing big in AI and in data centers and so forth. So if you look at all of the investment going into AI, which is a bubble, it's like the internet bubble at the turn of the century, well, we got an
Yes.
AI bubble, but it's bigger than the internet bubble, bigger in the sense of total investments going into it. U.S. businesses, investors are really rolling the dice on AI. Is AI going to lead to so much productivity and they can lay off millions and make more profits by reducing their costs, right? Or is it not? The seven or 10, well, the big seven we know about, Meta and all those big seven, Nvidia, etc. And then if you throw in Tesla and a few others, Google, Alphabet, C stocks, well, then you get the top 10. Well, they're responsible for over half of all the AI investment, those 7 or 10 companies. So all this run up in the stock markets, we're talking about 40, 50% over the last 18 months, is driven by 7 or 8 companies. That's it. And that's driven by AI. If you remove the investment in AI over the last 6 months, the US economy GDP would be flat. There would be no growth whatsoever because the only thing really driving it is business investment in AI in those seven companies. So all this stock appreciation is AI driven, 7 or 8 companies driven. And if you took that away, there'd be no growth in the US economy, the real economy. It would be flat. And that's even given the fact that you've got business investment in AI data centers and so forth. I think it's going to go bust because the problem with AI is that it won't be able to really penetrate the rest of the business sector very well or very quickly. You got a lot of big investment now by these big 7 or 8 companies, and they're really rolling the dice on this. And yeah, they're building data centers and so forth. But for AI really to continue its growth path, it has to get adopted by the rest of the businesses and companies. And the problem is this, and why it won't very quickly, is that companies who aren't the big seven don't realize that in order to implement AI, I'm not just talking about the toy Jet GPT, right? I'm not talking about that. I'm talking about AI in business sense. To really implement it, they've got to upgrade their data architecture. Big costs to update their data in order to be able to use AI. And they're running into a wall now. A lot of companies are beginning to realize that, gee, it's going to cost us so much more. Where are we going to get the money? Well, we're going to have to borrow it. You're going to see corporate debt go up significantly now because they all feel they got to play in AI. You see, the thing about AI, its real attractiveness to business is it allows them to get rid of labor and employment, right? That's the key. Raise productivity, reduce costs, raise profits. So it's really going to kill the labor market once it really gets going because AI, the whole thing about artificial intelligence is to remove simple decision-making jobs in services, not just robots in manufacturing, in services. A lot of these low-level jobs, customer service reps, retail, services of all kinds, they're going away. Even Goldman Sachs a couple of years ago estimated it's going to result in 300 million lost jobs, AI, once it gets going. So the whole thing about AI is to cut employment, get rid of the entry, a lot of service entry level jobs because we haven't really been generating high level jobs. Excuse me, a lot of service jobs, but those are going to go away. But the problem is, I don't think AI is going to penetrate the business sector at the rate they expect. And then you're going to see the big seven say, well, we've gone as far as we can here. Let's slow down. And then if that's all the thing that's driving the economy, what's going to happen to the economy in the U.S.? That's
Well, let me ask you this.
behind the bubble.
Let me ask you this: tariffs, government shutdown, soybeans. I know you're familiar with that disaster, et cetera. There are some very negative indicators for the U.S. empire. How does this trade war with China doesn't look good? China's not. I don't think they're coming back. I don't think they're going to buy soybeans. They can bail the soybean farmers out this year. They no point in planting soybeans in the fall. In the spring. China's not coming back for soybeans. You'll just have to eternally bail out the soybean farmers. But there's an entire infrastructure. There's trucks that move soybeans. There's factories that process soybeans. There's ships. The entire infrastructure to that farming area of employment goes. It seems to me that this trade war is moving towards disastrous effects, coupled with the government shutdown. Doesn't sound like a good winter is coming, Dr. Jack.
Yeah, well, the trade war is morphing into an economic war, right? You just mentioned the response to China not buying U.S. soybeans, right? They'll go to Brazil or other places. They probably already signed the contracts. But it's not just the soybean response. We know about all the rare earths China is holding back rare earths, which are necessary for tech and military production in the U.S. Big issue, rare earths. And on top of that, they've done some moves on shipping. They've cut back shipping, and they're also beginning to require other countries that China does sell rare earths to, not to resell products back to the U.S. with those rare earths. So it's kind of like China's version of threat of secondary sanctions on the U.S. The U.S. is trying to do secondary sanctions on them, etc. So you've got moves being made, not just in terms of tariffs on goods exports and imports between the two countries. And what's clear is China is calling Trump's bluff, and they're going to the mat with the U.S. here, and Trump keeps backing off. He throws out these big announcements, 100% tariff, then he backs off. Right? It's all for PR, really. But when the rubber hits the road, there's all kind of exemptions to the tariffs and everything, and he's going very slow with China. In contrast to the other country, like Europe, 15% tariffs and increases, and Japan, the same thing. And so that's the low-hanging tariff fruit that Trump has been plucking. But China is, that's the meat in terms of the deficit. And the U.S. is still running $1 trillion a year trade goods deficit. $1 trillion. It was running almost $2 trillion, in the first quarter, but now it's still running $1 trillion. And the tariffs haven't had that much effect. But the tariffs are all about, in my opinion, is Trump raising revenues to offset the loss of government revenues, which comes from these massive tax cuts for the rich and investors. He's trying to use tariffs to offset that revenue loss to the U.S. government, and it's working to some extent. Tariff revenues are up over $100 billion this year. So I think that's what it's about, mostly the tariff wars, raising revenues. Because as I'm writing in my forthcoming book, The Twilight American Imperialism, out later this year, is that the U.S. empire cannot afford the cost of empire anymore. The costs have far outrun the returns. And that's why long term the U.S. is going to pull out of NATO financially, or pull back from NATO financially, because that's not as strategic to the empire anymore. I'm talking about the American empire. What's strategic to the empire is the Western Hemisphere and the Pacific. And that's given the fact they cannot afford the cost of empire the way they did 20 years ago globally. There's going to be a kind of consolidation going on. And I think we're on the cusp of that. Retreating back to the West, cleaning up the Western Hemisphere, because, all this stuff about Venezuela and Greenland and Panama, right? What is that all about? That's about trying to push China out from its penetration in these countries and these economies. China has penetrated the Western Hemisphere economically in a pretty significant way. And what you got is the U.S. trying to bump them out again, as they did in Panama, as they did in Mexico, and as they will in Ecuador and Peru, and in Greenland. You see, that's what that's about, because China's investing in mineral rights in Greenland, and the U.S. wants to push them out. So you got to see this return to the Western Hemisphere focus, because they let it lapse, as part of this consolidation of the empire to the Western Hemisphere and the Pacific, which the U.S. considers this lake, right? And
Before
a withdrawal.
I did want to ask you this real quick before we go, and that is, we only got about 3 or 4 minutes, but the European economy seems to be in tatters and going down in flames. How bad is it? And like I said, we only got about 2 or 3 minutes. A brief and summed up.
Yeah, well, if you look at the two big engines, UK and Germany, UK is flat. and Germany is contracting. And if you look at the Eurozone wide, it's flat, only grew 0.1% here. So all across the board, business confidence is down, consumer confidence is down, trade is down, and countries like Germany, half of their GDP is trade. They're all the indicators are going south in Europe. Particularly for GDP and for government debt, but military expenditures are going up. You see, the government revenues are going down, but military expenditures are going up, particularly in the UK and Germany. So that's the real thing to take away from the European economy. It's real economy, it's industrial economy, manufacturing and PMIs and so forth, industrial production are all going south, continuing to go south slowly but steadily. And the whole economy is slowing down in Europe. That's why I believe they need the war. You see, my analysis is they need the war in Ukraine to keep going in order to justify to their population that they got to do military spending because their economy has been, in a crapper for at least a decade and a half. Europe cannot get its economy going. It stagnates or slips into a recession time and time again. And the only way I think these elites, at least at the Eurozone level, think that they can, jumpstart the economy is to do military spending. And to do that, they need the Ukraine war to continue to justify to its population that the Russians are coming, right? We got to militarize, particularly since the writing on the war is the U.S., Trump and so forth are going to pull back financially from NATO. That's why, it's not just they're crazy. There's a material reason why they are totally in support of the Ukraine war.